Hello and welcome once again to the Smart Money, Dumb Money Show. I am your host as usual, Keith Richards. I am President and Chief Portfolio Manager at ValueTrend Wealth Management, and I am a technical analyst. Today we're going to talk about risk. And I was inspired to do this video by a man I really respect, a long-term portfolio managers, probably one of the most respected portfolio managers in the world, Howard Marks, down in the good old US of A. And he is president and CEO of Oak Tree Capital Management. And brilliant guy. He's written some books, a book that I was very inspired with in my earlier life. And he's writes a memo every few months called the Oak Tree Memo, I think it's called, and just puts out some great philosophical thoughts on investing. So he did a series of videos recently on risk, and I watched it and I borrowed a little bit from his videos, but I also incorporated stuff that ValueTrend has incorporated for many, many decades. As you know, if you know anything about my company, ValueTrend, our literal tagline is limit your risk, keep your money. And so risk is something that we have always focused on. And I'm going to talk a little bit about why we focus on it and how one can evade or at least limit your risk with some very quantitative tools. And that was the one thing I thought that Howard was missing out of his lecture series on risk is, okay, we know about risk, what do we do about it? So let's talk about what is risk, and then I'll give you some ideas on how ValueTrend deals with risk. So let's get started. I often put together PowerPoint presentations for this kind of thing, and this is no exception. So this is a quote from Howard Marks, and it says, you can't predict, you can prepare. And by the way, the book that I was so inspired by many years ago by Howard Marks is called The Most Important Thing. And I do recommend you read it if you want a good book on investment philosophy. True to Howard's style, he does not often give a lot of direct platforms or suggestions on how to deal with these philosophies. So that's why I am doing this video today, but I think he's still very worth reading. So let's talk about risk. There's many different types of risk. There's I think selling incorrectly is the big one, because generally speaking, with buying incorrectly, yes, you can buy at the wrong point and watch the stock or commodity go down. But so long as you've got a good selling strategy in place, you actually can cover your butt with buying incorrectly. But if you're not selling incorrectly to begin with, then you're in trouble. And we're going to cover that in a minute, because all forms of risk, with the exception of black swans or super parabolic moves to the downside, most types of risk can be limited, not avoided all the time, but definitely limited. The more minor forms of risk are missed opportunities. You woulda, coulda, shoulda. Actually, we at ValueTrend had one. We identified NVIDIA at the beginning of 23 as a potential buy, didn't get on it early enough, and missed out on a lot of upside because it moved so quickly. So there's that's a missed opportunity. Didn't really hurt our portfolio, except that maybe we would have made a bit better return. Emotional decisions to me are the epicenter of all types of risk, especially when it comes to selling and buying incorrectly. You're not following a system when you're investing emotionally, and we'll talk a bit about that. Of course, the tie-in to not selling correctly is permanent loss. And so that's very different from time risk, which is the amount of time it takes to recover your money after a drawdown. So, one could point at a security that's fallen. Well, if you're a buy and hold investor, you'll say, yeah, it's a good company to come back. And it may, but it may take many, many years, and we'll show an example of that in a few minutes, to come back. Whereas a permanent loss, it's a company that's never going to come back. And we'll talk about that right away. Good old Enron. By the way, Canada had its own Enron type of performing stock called Nortel years ago. So same sort of chart pattern where it went up very hard and then Enron went literally down to zero. And as anybody that remembers the 1990s in Canada, it was all about Nortel. And of course, they went up to the sky and fell hard as well. So this was permanent loss. If you held on to Enron through the downturn, you eventually turned your $90 into zero in this case, $90 a share. So keeping in mind that you need to have a sell strategy, you can see why you need a sell strategy. That's the most important thing you can do to control risk. Even if you buy incorrectly, you bought right here on Enron. If you had a sell strategy, and I will talk about that later, you wouldn't have written it down to zero. Okay? You would have lost money if you bought it at the top, but you didn't write it to zero. Let's talk about another period of time that I was invested in the market. I've been in this business since 1990, and I was a live participant in the tech bubble. I owned Nortel, for example. I wasn't, super heavy into the tech stuff, but I did own some tech stocks, and I got creamed on Nortel. So I didn't put a Nortel chart up today, but I did eventually get out before it turned into zero. But that experience taught me a lot about how to get up earlier, how to get out earlier, I should say. So we won't, this chart we're going to revisit in a minute, but what I want to emphasize here is the time risk. Remember, we talked about permanent loss and there's time to recovery. Well, this is the NASDAQ, and it hit about 4,800 in mid 2000 and 2000. And by 2002, it hit basically 800, 795 to be exact. Well, you think of it, you had to have not one doubling, not two doublings, but 2.5 doublings for that stock, or that index, I should say, to get back to 4,800. So even though there was an 83% loss from peak to trough, as you can see on my chart here, the actual recovery was something like 250% before you even got back to break even. So time of recovery is a major risk. Sure, the NASDAQ today is well above those levels, but that doesn't matter because it literally took 5 years. If you bought somewhere up here and didn't have a proper sell strategy to get you out at a smaller loss, you took years and years, like 5 years, just to see your portfolio break even. And this is not, to me, a good strategy. That's one of the reasons I'm not a believer in indexing and buy and hold. Now, here's another chart that I want to show you. This is directly from Howard Marks's video series. I stole it. So all the credit to Howard Marks and Oak Tree Capital Management here. What he did was he drew the traditional line here, which is the risk return line, which is when you have a very, very low risk instrument, like a treasury bill, for example, you have almost zero risk. It can't be zero risk because there's always potential that even in the United States of America or Canada, that the government could go bankrupt. It's pretty darn low, the chances, because they can always print money, as you know. But let's say there's still some risk to that investment. And we won't talk about inflation risk and time of money and stuff. We're just talking about loss of capital here. And with a treasury bill, there's very little return and very little risk. Now let's talk about a biotech stock or something like that, way out here on the risk line, like at the far, far right. But also potential return is high. The only thing that they don't talk about with this nice and tidy straight line is what are the possible outcomes? Because there's a lot of outcomes that can happen when you buy biotech or when you buy a good quality company. You're still there on the risk and return line, but you can see very, very different potential outcomes. And so let's take a look at the biotech stock. Your potential outcome could be extremely high. You might buy it at, pretend, $1 a share, and it could be worth $100 a share a year later. You could have had a huge return, but you also could lose everything. on that biotech stock that has that potential. That's your potential outcomes. And you actually don't 100% know. So when people say they know what's going to happen based on this risk return line, they don't know. It could be well above or well below that line. So let's go to maybe more of a traditional stock. And this would sort of be as a manager where ValueTrend falls in. We can have a short period of downside that could swing off the line, and also a short period of outperformance. But we at ValueTrend rarely see negative years at all, and if so, very, very minor. This might be maybe a slightly more aggressive strategy than ours, and or slightly more type of stock than we might buy. So but on either case, it's really no right answer here. It's just that understand that there are still a multiple of outcomes with every move up that risk return scale. So let me just give you examples. Now this is managers, okay? So let's take a manager who just follows the index, or say you are just an index buyer. You're a buy and hold index buyer, and you buy the S&P 500 and the SPY, which is the traditional S&P 500 ETF, and you hold it. Okay. Well, let's just pretend that the market 1 year makes 10%. It goes up 10%. And the following year, it goes down 10%. Okay. Well, with the buy and hold investor, they went up 10%. And then the following year, they went down 10%. Okay, so net, they kind of broke even. Well, that's okay. They're a long-term investor, but just understand that's your parameters. That's the potential outcomes in this scenario. All right. Now let's take a more active investor. And this is a very good investor, a very good manager. And this manager is really smart. So this manager manages to make what the market made. And they followed the market up 10%, but when it fell the following year by 10%, they only lost 5%. So net, the end of that second year, they made 5% net. Pretty good. Okay, let's take a third manager. Now, they might sometimes underperform the market because they have a very high, sensitive, I should say, system to risk. And by the way, this is kind of an example of ValueTrend here. And in fact, if you look at our performance, this is very typical to us. We might range in a good year anywhere between 8 to 10%, because if that 10% up market is showing signs of being parabolic or showing signs of being overly risky through some of the parameters that we follow, like sentiment and stuff like that, then we might pull out a little early and only make 8% in that 10%. However, if in that same market, because we pick positive sectors, we've done this many years. You might remember a couple of years ago we were buying oil when nobody else was, and we made a well above market return that particular year. So we would have made 12% in the market that only went up 8 or 10, I should say. So this is sort of a range type of situation in a 10% up market. But in any given down market, in this case, the 10% down would result maybe similarly in this hypothetical situation to the manager that's been pretty consistent, 10% up, 5% down. You can see that at the end of the day, if this manager sticks to this range, 8 to 12% in the up years, it's kind of like 10% on average. So it's just less, I guess you'd say, it's less vulnerable with more potential upside. That going back to that, maybe a bit more potential to the upside with this person versus that. But at the end of the day, they have about the same risk profile, don't they? Okay, now let's look at a manager that is, I'm going to give an example of the manager that was buying all those innovative stocks. It was called ARK. And some of you might be familiar with that. It's an actively managed ETF in the United States. And ARK I can't remember the woman's name that runs it, but she's brilliant. She picked a lot of great companies, and she was making typical, double market returns. However, when the markets turned down on some of those more aggressive stocks, just a couple of years ago, actually, like in 22, she more than doubled the downside. She was having like a 40% down year when the market fell about 25% in 22. So, that's that big range manager like we were talking about here. Okay. In the long run, you hope that this might average out to be slightly ahead of the market, which is the 10 up, 10 down, or maybe even slightly ahead of these two guys. But there's an awful lot of swing and no guarantee of that happening. So most people are usually happier with these type of managers than either that one or that one. Although lots of people are satisfied with the buy and hold ETF platform, okay, and accept the market downs. So let's talk about measuring risk. And this is sort of the beginning of our conversation on how we reduce that risk. So this is a stock that ValueTrend has a position in our aggressive platform, okay? This is not yet, anyways, in our conservative platform. We like Ford for its recovery potential, not necessarily its long-term potential. We were buying it at around 9.5, okay, and you can see it's bounced off of that. We made a little bit of money so far, but what I want to talk about is the risk. So you can see this is our potential for upside, maybe 14 bucks. That would be great. If we bought it at 9.5 and sold it at 14, we'll be very happy campers indeed. But what's our downside? Because this stock could turn sour on us. Well, you can see there's been massive support. So I'm assuming many of you watching this video are familiar with technical analysis. And when a stock finds support at around that 9.5 over and over and over and over basically almost 3 years, you know that 9.5 is pretty strong support. That's where buyers are coming in. Every time it gets to that point, guys like me step in and buy it. Okay, and that makes it go up. All right. So you now know what the risk is, and that is that if it goes below 9.5, let's call it, let's say 9, just to keep the number simple. If it goes below 9, because it has gone to $9 a couple times, then you want to get out. So we have some sort of a strategy, and that's taught in my online course at valuetrend.ca. And that strategy is we wait a period of time, let's find out if it's just a spike, like maybe this right here, this little move right here was a spike, and you give it some time to prove that it was just a spike and not an actual breakdown. However, after a period of time, as I describe in my course, and especially if some of the indicators that are starting to round over, momentum indicators, etc., you can sell. So that's your way of measuring your risk, which is I don't want to see it go below $9, and controlling the risk, which is to sell if it stays below $9 for any period of time that's reasonable. Okay. Now, I want to give another example. We do not own this. This is the iShares Japan ETF, and I'm going back to 2020 here. And you can see there was massive support. Remember, we just talked about supports where buyers come in. Back in 21, it would bounce off of about 62 bucks over and over and over again. Okay, so if you were long that stock, let's say you had been owning the Japanese index, and you were wondering if how do you know when to get out? Well, my rule of thumb is higher highs and higher lows, or a consistently steady level above a support level. I'm okay with that. Now, when a stock breaks its 200-day moving average, which is what this blue line is, it's the 40-week, which is the same as the 200-day. If it breaks the 200-day and it starts making lower highs and lower lows and takes out that vital support, then we're out of the stock. So if I had owned EWJ back here, and honestly, I think I might have, but I can't remember. But if we had owned that stock and we saw this break and we knew it was already below the 200-day, we would have exited right in here. We would have counted a few days and then gotten out. We would have avoided all this. By the way, entry point is the opposite, break above the 200-day, higher high, higher low. But we're here to talk about risk control. So here we are. Let's pretend you're in this trade right now. It's actually been pretty cooperative. It moved below the 200-day at one point, but it didn't last too long. And then it moved to a new level. Now you can see there's massive support around $66, just to keep the number round, okay? Now at one point it did spike below that. Remember I talked about you need a few days or maybe even a couple of weeks to see if that spike is the real McCoy, if it's an actual breakdown or not. And that's why we have rules like that, because if you had sold just because it broke support and just because it moved below the 200-day, which is this here, the 200-day moving average, you would have been what's called whipsawed. You would have been whipped out of the stock and then cursing yourself right now because it went right back up. So you've got to have these rules. And again, I talk about all these rules in my course. Now you can see that the stock is consolidating. It seems to have a little bit of a lid around 71 bucks or so, and then a floor around 66 bucks or so. Your risk control here is if this stock breaks below $66 and stays below that level and the 200-day for more than a few days, you're going to sell it. You have to determine the amount of days you're going to count, but again, take my online course for some guidance on that because I have some hard and fast rules on it. Okay, so the next thing, we're going to look at that same chart we looked at the beginning of this lecture, and that is the NASDAQ in 2000. So here we have an uptrend and a parabolic move there, signified by this uptrend. We have the 200-day moving average, which is something I pay more attention to, okay? And boom, the stock, this is a daily chart, you'll notice, so it is the 200-day, the green line. And the stock and the index moved below the 200 and it took out the trend line and it made a lower low right around here. This is where I would have been selling. So would I have sold at the top? Heck no, I would have sold at around 3,000 or maybe 3,500. Okay, somewhere around here actually. Okay, so that's where I would have sold. And you go, oh yeah, well you didn't sell at 4,800. Well, nobody that's telling you the truth with consistently can sell at the all-time highs. So you need some sort of a system, because for most of us, this just looked like a consolidation. And I can tell you, I was trading at that time, and that's what it looked like. It just looked like a triangular consolidation. It broke down, and that's how you get out. Okay, so it avoided seeing 795 2 years later on the index and waiting until, as we mentioned at the beginning of the show, 2006 before you even saw the market recover. You would have recovered in this period of time literally within a year or so after selling, within, I should say, about 3 years rather than 5 years. Okay, you actually would have recovered in far less time, I'm sorry, because you would have sold up here, you would have had the cash and probably been looking at, as this base built and broke out, you would have been probably buying somewhere in here and making all kinds of money. So that is why market timing, which is not selling at the top and not buying at the bottom, but that is why having a sell system, a risk limiting system, is so important, because you can trade any market. Okay, so I'm going to leave you with a few quotes, and these are just 3 of my favorites. There's a little known investor named Warren Buffett. Some of you might have heard of him, but he's kind of just a new and emerging guy that's trying to make his way in the world. Warren Buffett says that when the tide goes out, you can see who's not wearing a bathing suit. In other words, you find out who doesn't have a loss control system. Okay, Howard Marks, again, who this video was inspired by, it's not what you buy, it's what you pay for that stock. So again, entry is important too. Okay, and my own saying, and I've been saying this since the 1990s, and this is a Keith Richards original, not the Rolling Stones guy, but mine. A system will save you from yourself. I am so fixated on trying to drive into all of your cranial vaults that you've got to have a system. If you take my online course, you will learn a very, very good system, and you will save you from yourself. I absolutely promise you on that. Final thing is the value trend byline, if you will. We say limit your risk, keep your money. Because as you saw with the NASDAQ example, it wasn't just, limiting your risk from a downside potential, but it is how long it's going to take to get your money back. And if you can limit that downside, you can't eliminate it in the market, because markets sometimes move the wrong way, stocks sometimes move the wrong way, and you're not going to be able to tell where the top is. But if you can limit that downside, then you will limit your overall risk, including your risk of the next Enron or Nortel, and you will be able to keep more of your money, because you're going to get out at a much higher point than had you held and hoped, as many people do. So I'll leave you with one thought, and that is that great portfolio management is not about market return with the same downside. It's about having a systematic manager, and I like to think ValueTrend is one of the few that manage to do this well, having a manager that can identify risk and limit the downside during the downturns, and hopefully make a reasonable rate of return when the good times are here. So hopefully that was a worthy seminar, or if you want to call that a video seminar to watch for you. I hope you got something out of it, and I do hope that you will employ some sort of a risk loss system so that you can keep your risk at the lowest possible outcome when and if bad times come along on the market or any of your securities, because it's going to happen. You just need to know how to control and limit the risk. You can't avoid it. Thanks very much for watching, and we'll see you next time.